If Angela Merkel were to wake up tomorrow morning and say, you know what, forget about this pipeline into Russia, I'm going to buy it all from the United States, what would be entailed?
So it's tens and tens of billions of dollars of investment and sort of anywhere between 7 and 10 years to make it happen. I think the first thing is energy security has driven European energy policy for the last 20 years. In 2009, Russia reduced gas supplies to Ukraine, but the pressure didn't drop in Kiev. It dropped in Milan and Prague and Warsaw. So this has shaped European policy. And I think what they're driving more than anything else is diversification of sources. I do think there will be significant quantities of U.S. Natural gas transported into Europe over time.
So are they going to invest those tens and tens of billions of dollars over the next 7 to 10 years?
I think there's no question that you will see on the back of the shale gas dynamic in the United States, it's turned the global gas industry on its head. The export facilities in the United States will begin to import, or export, should I say, into Europe, and you'll see new import facilities built in Europe.
So perfect segue, because you guys just raised a $1.5 billion energy infrastructure fund, right? So where would you want to put that money, Europe or U.S.?
So I'll put it wherever I get a good return on that capital. And
where's the best return?
And so it depends. What I would say to you, we're seeing structural shift in the global energy and power market. It's all technology driven. The shale dynamic in the likes of the Permian and Texas has changed the world of oil and gas. And it's driving massive new investment. And the corporate strategic balance sheets are capital constrained. And so they've turned to financial capital for the first time. We've just had a first close on the fund of $1.5 billion, tend to raise substantially more than that, to invest into that. Power generation, the same. Renewables has turned that on its head. Natural gas has turned it on its head. And we're seeing massive investment opportunity throughout, let's call it, the developed economies.
So traditionally, this is how I would look at, say, pipelines, for example, or even terminal exports, like look at Cheniere. So you wind up, you go outside and you say, hey, I'm going to build this thing, commit to using my terminal or pipeline for 20, 30 years, and give me this much money. Take that, go to the bank, get a nice loan. How has that world changed, and what opportunity does that create for you?
So I think in substance that world hasn't changed, in the sense that the developer will still look for those long-term 20-year, 30-year take-or-pay contracts. I think that as well as the debt, they need equity. Historically, it's been the large oil and gas majors that provided the equity for those projects. But I think in this more capital-constrained environment, as they've been dealing with for the last 6, 7 years, where they've cut back capital expenditure, they're looking to financial capital to come in alongside them and supplement their equity.
And when you say that, does that mean that the pipeline guy is going to come to you and say, hey, let's talk? Or is it now going to be the producer, like an Anadarko or Apache, that's more of that's not a big integrated, that's going to come to you and say, let's do a deal with
It's actually going to be all. I mean, they all have their different needs, but we can play anywhere in the value chain, for want of a better description. But the big majors will come to you to work alongside you. Smaller developers will come and look to you to actually supply most of the equity capital. But I think you're seeing much more of that partnership around capital than you ever saw before.
When you go back, though, to the Putin situation, are you always at a disadvantage? Vladimir Putin doesn't have to go out and get a 30-year commitment and go to a bank and get a loan. Does the private equity always have something of a disadvantage when it's going up against a sovereign who's investing in pipelines?
Technology.
Indeed, but the scale of what's being done means the sovereigns can't supply it all. And so we're just seeing massive growth and opportunity. And that's throughout the world, actually.
And a lot of people think that the way you do. I mean, we've seen KKR raise an infrastructure fund. We've seen Blackstone do it. There's a ton of money in general in private equity for it. How do you compete? So what's your offer set if you go and you want to pitch yourself when there's somebody else who has just as much money or more?
Yeah, so I think as BlackRock, we've a couple of differences. The first is we already have relationships with all the major corporates in the world, and so that's very easy to leverage in the context of looking for opportunity. The second is we have a global footprint, and so when we turn up in a country, we're already part of the business, the political, the regulatory ecosystem, and that's phenomenal advantage when you're looking to originate and underwrite and asset manage. I think the final piece is what we're sort of very strong on is very deep expertise in the assets. Frankly, more expertise means you've made more mistakes, and that means you're less likely to make them in the future. And so that's a big factor in how we position ourselves.
As Alex says, a lot of money's been raised for these funds. A lot of it doesn't seem to have been invested yet. Are we waiting for public money? Because there was a time the administration was saying we're going to do private-public partnerships, and that's going to really trigger it.
So again, it's slightly different dynamics there. The energy and power markets are actually already deregulated, they're market-based, and so that it dominates the infrastructure market in the United States. 85% plus is energy and power. I think what the government was trying to do here was stimulate other infrastructure, transport, social infrastructure, and that's much more challenging, and it's not imminent, is the short answer.